Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Here comes another weekend at the end of a shortened trading week in markets. Probably, at least for me and a good chunk of Europe, Monday will be festivity as well. I know for you in the US, there was Good Friday just yesterday, so the markets were closed. So, pretty much a long weekend across the globe if you look at that overall, which is why, as you can read, it's pretty late in the morning. I wasn't in a rush to put out this video because I was expecting, a lot of people may be traveling and probably not going to have the time or the willingness to watch this one. But nonetheless, there were a few things worth noticing throughout the week. So let's start out with the economic calendar, which presented a lot of things, but a few of them, especially in the first part of the week, they were just data related still to February. So I don't think the market really cared about them. And what it's, more related to March, which is, most recent times, I think the market would be paying more attention to that, if anything, right? Because, right now it's all about oil, inflation, Iran war and all the rest. So maybe, just maybe, the economic calendar and the economic data releases are taking the backseat for now. But let's just quickly look at them. So we got the jobs opening, which came in at what? Well, first of all, as you can see, they were for February. So do we really care? Maybe, maybe not. Nonetheless, they're still in this downward trajectory. And as you can see, they came in below the previous read, below expectations, not by a lot, but yet still below. So nothing new here, to be fair. So I would just, is it important? Yeah, it is. But for now, I think there are a lot of mixed up signals from the labor market, as we will see. And so, it becomes a bit difficult to really dig into the data and try to come up with what could resemble reality. All right. Now, then what we got is ADP employment change. And these came in above expectations, obviously slightly below the previous read. And as you can see, if you zoom out to the last 5 years, that line, it's not moving, right? So, not a lot for me into that. Or at least, nothing sensational, or, you wouldn't write home about any of these, in my view. You pretty much have your conditions already set up in the labor market. Now, maybe we are getting into some sort of a stall, right? No hiring, no firing. The labor market is just freezed, maybe. Then we got, but still, February data, retail sales, which came in positive, to be honest, especially because the previous read was a negative one. But still, when I read at these, 60 basis points, then what? When you adjust it for inflation, which is still at 2.4, again, that just means that you are paying more to get less. So I don't take it as a positive. Sure, it's still, comparing it to the situation where it comes in negative, it is on the positive side. But overall, I don't put a lot of emphasis on this one for now. Then what? ISM manufacturing PMI, three prints of very good results above the 50 level, actually 51. So it looks like we are having a little bit of an uptick in this data set. If you read the text, you will see where the majority of progress were materialized and where they weren't. But overall, okay, fine enough, I guess. Wouldn't call it a victory for the plan of bringing back manufacturing in the US yet. But as I said in the past, these type of policies, they can take months, if not years. So, judging on just 3 bars for me, well, again, it's kind of nice to see that, but I would like to see a trend developing, like it was in this case, right? Was it good in here? Yeah, up until the point it didn't go like that. So, just give it time. We're talking macro data here, all right? Then what? The employment situation, which again, The last three data points were good enough, but still, this one, it's below 50 for now. So a little bit of an improvement, but still the trend, I see it kind of to the downside. So not, in the grand scheme of things, not a lot of progress in here, right? Moving on, we got NFP, which came in at 170K. You might say stellar, right? Is it? I mean, we've seen it in the past. And then what? Plus, I think, all the revisions, all the things, it's becoming a little bit of a meme now, especially this week in particular. It became a meme when I've seen that the market on Friday, although it was Good Friday, would have stayed open for an additional 45 minutes after the release of the data, which, I mean, what's up with that? Do you already know the data is particularly good, so you would like the market to react positively to it and maybe, engineering a positive close? Well, as we will see next, it wasn't necessarily the result that you were expecting if that was your aim. But, on the other hand, the market already rallied the previous day and it basically held the gains which materialized throughout the previous part of the week. So, let's call it a draw, right? And we are all happy ever after. We got unemployment rate, 4.3. He's still being particularly stable around these levels. You might say, well, again, the labor market, it's stalling maybe. So, it's not worsening. It's not improving. It's just where it is. Although, when you look at the U6, it tells a different story. I'm not going to go into the difference in between the U6 and the U3 once again. Reference previous videos or just Google it if you wish. This one, it looks like it improved even more than the headline, right? But still, compared to a few months back, hovering around pretty high levels for now, right? At least, if you consider the last 4 or 5 years, right? Then what really threw a dent in this entire narrative of the labor market being resilient in this one for me has always been this one, the participation rate. Just, it's just simple math, right? Just think about how things are calculated. I mean, it's unemployment being particularly stable, sure. But after 2020, we never, we had a drop. We never got back to the same levels of participation we had before. So is it cool to say, well, numbers are stable or maybe going down? Sure. If the base on which you apply that percentage, it's shrinking, basically. Does it really give you the true picture of reality? I don't know. I mean, at the very least, I would say it's a bit misleading, right? So don't be over optimistic at the very least, all right? And finally, what we got, average hourly earnings trending down over the last 3-4 years now. And weekly hours, even worse. You've seen the reflation after the 2020 stimulus, after the pandemic. And then what? Down and down we go. So again, if you factor in inflation, which sure spiked, then it came down, but it never came back down to the levels it was before the pandemic. And at the same time, what you see instead is that weekly hours, for instance, they spiked up and then they came back down below the levels they were pre-pandemic. So, if you start to zoom out over the last 6-7 years, is the American consumer better off or, worse off? I'll let you be the judge of that, right? Then what? 10 years break-evens, again, this delta, it's increasing. So, even this week, we have seen the 5 years going up. The 10-year, not really. Still boxing this range. And I think most likely the 10 years, which is having a little bit of a, farther into the future outlook, it's the one which is correct. And, actually, they could both be correct, right? In the short term, inflationary pressures, why not? But over the long enough run, maybe, not enough to get to sustained levels of inflation. All right. Now, let's skip this one because we don't need that right now. But to cut it short, Fed watch pricing in basically no cuts and no hikes for now. At least, I mean, if you don't want to put a lot of emphasis on these 50 basis points for a hike, right? But other than that, I think again the Fed will be hands off right now because I think whatever they do, they're gonna screw up. But not because they are necessarily stupid. It's just they are in a very difficult situation. So I think the best thing to do right now, if from an institutional standpoint, I'm not saying personally me and you, but for them, bureaucrats, what do? Well, nothing. Up until something big really happens one way or the other, I would do nothing. And, look, if things actually go well and everything turns out to be good, I will still be able to claim, see that? I did it. Thank me, right? If something, for some strange reason, actually goes south, you could still say, well, we were monitoring the situation, and then, when things actually went bad, we stepped in and we acted. So, again, even in this situation, thank us, right? Yeah, sure, all right. As for the credit spreads, yeah, still climbing higher. They're not spiking, but still, I think they are pricing in this stress, which is mounting and becoming much more and more evident in the private credit. Now, again, we went over private credit and the situation, the potential risks last week, so I'm not going to repeat all of that. Is it a risk? Yeah, it is. Could you see contagion one way or the other, or in a few sectors of the entire financial market? Probably, yeah, maybe. For instance, what do you do if you cannot sell your assets in the private equity? Well, you do realize they're underwater, so you're actually taking a loss, although you can't even realize that. So what do? Maybe, in order to cover the losses that you're already expecting, you're gonna sell something else, like, I don't know, stocks, maybe, right? So, it could, in one shape or form, manifest contagions in other sectors of the financial markets. But is it going to be like 2008? I don't think there are the premises yet, right? We'll see. But for now, I would say no. And that would end up the part on the economic calendar in the introduction. So let's skip into the next section, which is, of course, the charts. As for the charts, I don't need to tell you what we're going to start out with, the DXY, which, again, it behaved pretty much as expected. We had an attempt to break higher on Monday, which was quickly faded, still around these 100 level. And we have been talking about what, over a long enough period of time, 100 level for the DXY, it's kind of the mean, right? So when we tend to gravitate around it, we see a little bit of a wishy-washy price action, or, some sort of a choppy action, right? But again, what you remember what we said. Yeah, I mean, even if we fail in a sharp and clean break out of this region, don't expect a sharp pullback. Maybe it will be boxed out into this region for now. It looks like that's what we got. Sharp rejection, sure, new lows, even on a short term right here. No, actually closed the week with a bounce, and it closed pretty much in the middle of these box. So I'm not reading a lot into it for now. Again, short-term trading week. I wasn't expecting a lot from this week, to be honest, especially when it comes down to currencies, or maybe even, yields or rates, whatever. But, a little bit more volatility in other assets. Why not, right? Like oil or stocks. But, these sectors, these asset classes, not really. So this is what we got. And it's pretty much in line with what we were expecting. Spoiler alert, there will be a few things which won't be in line with what we were expecting, to some degree at the very least, all right? So moving on, the other currencies, of course, they're just a reflection of what the DXY did. So the euro bounced, and then another one faded. Funnily enough, when you look at that, it looks like for now, at the very least, the euro, it's getting a bit stronger compared to the British pound. Right? So the British pound is already back at the lows of these current Would you call it consolidation? I mean, for me, it you know, it looks a bit more like redistribution, but call it what you want. Still, back at the lows, the euro, not yet. You could also imagine some sort of a ascending trend line in here. Would you trust it? Personally, I wouldn't. But yeah, at least, you know, if it has to go down, looks like it's going down slower than one very closely correlated pair, like the British pound. The yen, again, bounced and then faded, but yeah, we're still hovering around that 160 level. So not good for the yen yet. I don't see any improvements in this one. If anything, I see further deterioration. Canadian dollar finally got back into the level that I don't have anymore in here, but I was talking about these, I guess, 2 weeks ago, or maybe 3, but here you go. Here you go. We are there once again. So now you got to see what's going to happen here. I would say when you test back into a level which was so sensitive in the past, if you're bullish, what you want to see, it's an immediate reaction to the upside, right? Kind of like this, getting back maybe in here, right? Filling in this price action right here. If you see it starting hovering around the lows, right, with no evident bounce, I would say the odds of this one actually breaking down are a bit more likely at that point, all right? But that's, you know, that's just some sort of if this then that. I'm not saying I'm expecting one or the other. I would just say give it a few more sessions and see how it behaves at these lows. As you can see in the past, it's totally possible that you have the sharp pullback, a little bit of a double bottom, and then it actually goes up. So let's see if this one could end up being like it was before, some sort of a double bottom, right? And then we should higher, or you know, if it's gonna show weakness and potentially drifting lower, right? The Swiss franc gave back all these move up we were looking at in the beginning of the year, and we are basically back in the same pretty, call it what, midterm type of a range. It's not long term, just a few months, but you know, it went on from basically the end of June 2025 up until January 2026. So good 6 months of range, right? Midterm seems like a good term. No pun, but yeah, right. A lot of repetitions. It looks just fair, right? Let's leave it at that. The other currencies, Chinese yuan being stable in here, so nothing to say about it. Indian rupee, yeah, bounce, pullback. It's now back into resistance, and I think again, just briefly, there are 2 levels of resistance in here. The first one was already tapped in, and you see on the daily the rejection, right? You look at the shadow of the candle. So as soon as we touched into it, we've seen a rejection. Although, again, absorption, back into it. So would you discard the possibility of, you know, a further push up or a little bit of a deeper retest? I wouldn't. I think actually that would fit, all right? So wouldn't be surprised. But overall, again, the trend is still the same. And the trend or the situation is still the same in the Brazilian real, which again, this week had the bounce and for now, at the very least, no fade. So, you know, Brazilian real confirming the strongest in this pack. South African rand still drifting down. Is it kind of like the Swiss franc, right? There is a long-term structure in here. We tried to escape that. We failed. At least we put in a top. Very technically, I think. And then now we are drifting back lower toward the bulk of the volumes. Yeah, it could be something like it. I mean, again, same type of a conclusion. It seems just fair, right? Then what? A Russian ruble, it tapped into resistance, so rejection, kind of like the Indian rupee. And then, you know, it looks like we pushed through on next level of interest, probably, yeah, around here, this one. A bit lower, maybe. Would you draw it like this? I think there is not not a lot of difference, but nonetheless, if you are a maniac, you can split hairs if you wish. Yeah, sure. But again, so basically, this is the same type of behavior you could, and again, could expect from the India rupee, right? Push into expected resistance, initial rejection, reapproaching it, and pushing through to the next level of resistance, right? So maybe could end up being the same in here, maybe. And then we will see what's going to happen here, right? The Australian dollar, again, same type of a top that we've seen in the South African rand. And now it looks like we are really trying to fill in this inefficient leg up that we have in here, right? So levels to the downside, well, I mean, this area right in here seems fair, right? As a potential destination. And then we see what's going to happen next. Probably would expect a bounce, at least on first pass. And then, after that, it becomes some sort of a game like the Canadian dollar, right? Do we have a sharp bounce? Do we get weakness? And then we try to drift lower, but that probably that would be a story for another week or another month, maybe, who knows, right? Let's start to get into the juicy things. So gold, for instance, what did gold do? We had the bounce, right? And then on Thursday, we got the rejection. Although, is it the rejection? Well, sure, I mean, price went down, but half of the move down was reabsorbed by the end of the day for the close, so I wouldn't necessarily call it a rejection. Although, again, it would fit what we were looking at. So this base was strong enough. The market took a lot of time to build this up, so it was difficult to think that we could have sliced through at first pass. Now, sure, we got the bounce. So again, we are now basically trying to assess whether we can actually materialize that scenario, which was about building up, right, a new dealing range. It doesn't necessarily have to be like this. It could even be like these, right? Goes up a bit, down a bit, then up a bit, then down again a bit, then up a bit, right? But it stays overall in this zone right here, right? So we'll see. We'll see. I mean, I don't know. I think if you look up, there are a few levels. I mean, the most classical one would be this one, obviously. But I think even this one, it could offer up. There is a low here. There is a candle close here, an inversion. So maybe even this one, if we can test back in it. If anything, in the very short term, we kinda front run that level. Oh, by the way, the same logic of this one could apply in here, right? Low inversion. Seems like we reacted to this one. So, what was I saying? Oh, yeah. Even if, right, you expect a sharp rejection above, right? Since we already got a little bit of a fade in here, if now we can push up to approach this level instead, it's like we are building up efficiently. So maybe another test back down, who knows? But doesn't necessarily mean that I would expect something like up and then down sharply. I think it needs, to me, it kind of needs to be choppy a little bit in here. After a prolonged enough phase of volatility, I think the market needs to get back, find its footing, building up new liquidity, building up new shelves, new. It depends. You can call them volume nodes, but building up volumes, building up inventories, right? So I think it would be just fair to see it being choppy a little while. Now, sure, we are in an headline-driven market, so could also be one announcement here and there. It could catapult this market to the upside, completely skipping these levels right here and getting back directly into the old apex, maybe. Or, it could plunge it back down to the recent lows. I'm particularly neutral on this asset right now because I think, if you look back at this one, right, this box, right, this gray box, I think we are kind of trying to do the same, but on a much larger time scale. So we are trying to build up a new structure. And over the long enough period of time, we might decide whether it was reaccumulation or its distribution. But for now, I don't have a particular bias on gold. I think it's good enough that we are holding the 4K level, big figure, yeah, yada yada. And I wouldn't give in on the fact that I have good vibes for this one over the long term, up until the point we can hold above 4K. So 4K for now, it's my line in the sand. And to the upside, I think, I know it sounds like meaningless, right? But, 4K to the downside, 5K to the upside. That's my range up until the point we are boxed in it, don't have a particular bias. But that's what I got on a macro scale. Because again, if you can reclaim 5K, not only it is a psychological level, but then, even structurally, you're back into this top. And if you can chew through it, what's going to stop you to target these highs right here or these highs right here? Right? At that point, the job is done. You had your correction, you had your pullback. If you can climb back higher, bulls are going to say, yeah, sure, this is it. That's the green light. Buy, right? So, that's what I got for gold, which is kind of the same for the other metals, to be fair. Although they're not looking as good as gold. Shocker, right? There's only one gold, right? It's like people in the crypto space. There is only one big daddy, and that big daddy is Bitcoin. There is a reason, because everything else is altcoins and Bitcoin is Bitcoin. Sure. Honestly, I think, with metals, you could kind of apply the same logic. I'm not saying the logic is flawed or stupid. It's just the way by which people try to bring it up that makes me laugh, but I'm not discarding it, absolutely, right? Actually, I think, again, for metals, I think gold is gold. The rest, it's the rest. Which, again, doesn't mean that necessarily at every single point in time in the future, gold will perform better than anything else. But, again, long term, I would pick gold over the rest, right? So as you can see, they didn't have the same type of bounce. They're not looking as strong as gold, especially if I look at silver, palladium, platinum. Copper is a little bit of a different beast for me. And even last week, we were looking at, if you zoom out, you see how, copper, despite the pullback, it held up relatively well, right? It's just a single line that you have to draw in here, which would be this one, right? High, so old highs. Breaking out, creating some sort of a breakout tag in here, using it as a launchpad. Up we go, yeah. Do we put a top in? Sure. So pull back, where to? Same level. So it was relevant in the past, and it looks like it's giving you a reaction now. We are, obviously, I would categorize this as being at resistance for now, but again, kind of the same logic as gold. If you think this is an apex, right? So the apex, for the jargon varies depending on what school you attended, right? But an apex, it's basically just a top. It's the base, apex base. It's the base which is broken and confirms the top, right? So if you can reclaim that level, you kind of start to negate the top or confirming it as a short-term top. So from there, right, if you can trade back into this range, after see it as a deviation to the lower part of the range, and then getting back in it, what's going to happen next? Well, usually you try to at least target the other side of the range, which is, in this case, it would be around 615, 616, something like it, right? But again, one step after the next, no, one step at a time, all right? First, you have to deal with these resistance, and then we will see, all right? Let's have a look instead, since we mentioned it, at Bitcoin, which, what is it doing? Again, would you call it some sort of a wedge structure? Maybe, if you do like formations like these. For me, actually, let's get rid of these. For me, we are just hovering around this established level of support. Although, you know, the one thing that I don't like, I didn't like it before, I don't like it now, is that first, if you zoom out, right, what you see, right? You see a down move, some sort of a pullback, which could, again, if you like formations, bear flag, now the flush, so you create a new pole for the flag. And what are you looking at now? Is it another bear flag? And then down we go. I mean, this is one of the main reasons because I don't like it, because it looks to me like nothing really changed. Right? The order flow is still the same. Down, sideways for 3-4 months, down again, sideways, down. I mean, I said 3-4 months. Is it really 4 months? No, it's November to January, just 2 at the end of the day. But still, you get the gist of it. I'm not yet seeing a change in behavior in this one. And again, considering everything which you can read in the news, I take it as we are in some sort of a risk-off stage in the market. And I deem it as one of the most risk-on assets on planet Earth. So, you know, fundamentally, sentimentally, and technically, for me, it's just hard to be bullish this one. Will it change in the future? Yeah, sure. It's one of the tragedies of this life. It always changes, right? But for now, not. And of course, tragedies, you should put the quotes, right? But it's just, it's ironic, right? Life is ever changing, and people always moan because life changes, but at the same time, they wish they could change the situation. Don't get me started with philosophical bullshit right now, but, you know, it applies to markets as well. That's my point, right? Oh, it's always doing the same, never does something different. Or he's doing nothing, yeah, up until the point he does it, and you're not there. So, you know, for now, I'm more on the side of waiting for it to actually do something. And quite honestly, I would expect, if anything, I would put a bit more odds on these trying to go lower before actually going higher. And then after it does, well, it becomes, again, tradable enough. Sure, it is tradable if you're trading the 15 minutes, the hourly time frame, but on a daily time frame, or on a weekly time frame, if you're looking at it from an investing standpoint, is it something which, you know, entice your appetite? I wouldn't say so for now, right? So let's leave it at that. Let's instead have a look at crude oil. Now, we were discussing last week its range, right? Now, sure, we are still kind of zoomed in on the 2 hours chart. So the week basically ended last week in here. And do you remember we identified his range? And what we said was, well, look, we would need, right, some sort of a breakout, some sort of a rounded retest, all right? And then maybe we push higher. Gotta be honest here, the retest, so first of all, the push up from here, to me, wasn't impulsive enough, right? Because, you know, I would have expected these sort of a move, right? I would have expected that to be the breakout, and then these rounded retests back into the range. Now, does it change the fact that nonetheless, we had the market going up, starting to build volumes above the range, right? And sure, we had a little bit of a drop, especially because it was on news, and then it was completely negated. So in this framework right here, did it work exactly as expected? Not really, okay, but, you know, the idea was kind of realized. And then if you just switch, if I remember how to do it, there you go. If you switch it to some sort of a system like that, when you look at the range is the same, you're just looking at potential deviations, right? What you see is that you basically get to the 0.4 deviation to the upside, considering the, you know, the range. And then you got back And in this case, again, the system is not mine. I've been quoting it many, many times in the past, and I always need to give credit to the person which presented that to me, which is a German guy, very smart, very polite, very nice guy to hang out with. It's been a while since I didn't hear from him, but anyway. So what you see is that even the two halves of the range, above the midpoint or the EQ of the range and below, they are divided in quadrant, right? So as you can see, yeah, we try to escape the range, we get back into it, we don't mean revert toward the EQ, but we find support at the upper quadrant boundaries, and then from there we shoot higher. So didn't work exactly as I was expecting, but it kind of worked, right? Under a different framework, it did. And the bias at the end of the day was, sure, if we can keep on climbing higher, let's get ready for even higher prices from there. Now, we are getting back to the highs. We had a little bit of volatility in here. And let me get rid of this one because it's cluttering the chart a lot. Let's see this one. Okay. So for now, I would say the risk, thanks, Captain Obvious, but it's still to the upside. And we were looking at the spreads, if you remember, 2 weeks ago, but I think to some degree even last week. But we checked a bunch of spreads, the calendar spread, the prompt spread. So let's have a look instead at what's going on, and comparing WTI with Brent, because it's kind of interesting what's going on now. I mean, do you remember there was a period where the Brent was in here, right? Was really higher compared to WTI, right? Now it looks like the situation it's turning a little bit with WTI actually pushing to the highs. Well, instead the Brent, pushed two, 3 times into these highs, and then it came back, and now it's nowhere near the highs compared to where WTI is. Am I reading too lot into it? I don't know, quite honestly. I mean, to me, one sort of mental masturbation I was attempting myself. I'm guilty of that, but let's be honest, who isn't, right? I was thinking, look, if I zoom out, let's say you look at the daily chart for both, all right? So as you can see, yeah, sure, on a closing base, right, it looks like this one, it's really going higher now, all right? And then you look instead at the Brent, which didn't take the highs yet on a closing base, right? It still looks a bit more of a consolidation, who knows? Although, we basically inverted these 2 bearish candles right here. So I would still expecting it to catch up, right, to the upside. But the mental masturbation was this. I've seen Trump talking about, well, look, if you can have oil or get oil from the Middle East because the Strait of Hormuz is closed, the first advice I would have for you is buy it from the US. And I was like, sure, I mean, from a business perspective, it makes sense. You generate more revenues if you can sell more oil, especially to Europeans, right? I think the vast majority he talks like that, I think he's referring to his European quote-unquote partners or allies. Are we still allies, by the way? I don't know. To TBD, we don't know for now. But the thing would be, look, it might be good for the government as a whole, right? You generate more revenues if you can sell more. But for the consumers, what's going to happen if actually Europeans start to bid WTI, right? Because they cannot have access to what they usually get, but WTI will go higher. And the demand will shift from what they cannot physically reach to what they can, and therefore this one will go higher faster than this one. Is it a plus or a minus for the American consumer, and aka for the American economy, which is again 70% consumption? I mean, I don't know. Sure, it's good. It's always the same type of logic. It's good for America as a country, government? Maybe. Is it good for the people of America? I'm still struggling with that. And I think I let time to be the judge of it for now, right? Although I would say if I was a citizen, I wouldn't like to have other foreigners to beat up my domestic market. So competing with me for the same oil, right? It's kind of like what you see that there is a huge, I'm digressing a bit, I know, but there is a huge debate now on TV. I think it's not just in my country. I think it would be all across Europe and maybe the rest of the world. But people are saying, look, it's insane. How come that the price at the pump, it's increasing the very same day we have a war in Iran? Those guys are still selling the reserves, the oil that they purchased like 2 months ago when it was what? 60, 70? So this is just speculation at the end of the day. I mean, I'm not denying the fact that there is speculation in markets. I actually think speculation, it's basically at the core of every market movement. You're always trying to price in the future, right? Which by nature, it is speculation already because you don't know. So it's a bet, right? But everyone is trying to do that. But another thing I would say, look, logically, what would you say? If you are a supplier of oil, right? And you see there are events going on in the world which could impact the availability of oil. You need to reprice that one now, because if you keep on selling it at the same levels you were selling it before, now that the event materialized itself, I mean, you start to think in terms, look, what I'm selling, regardless what I paid for and the margins I'm realizing on it, but what I'm selling, it's at risk of becoming more scarce in the future. So, there are logical evidences, the Strait of Hormuz being closed, that the commodity I'm selling now, it's going to be less available for the public in the future. So the repricing happens now on the expectations that the availability of that shit will be less into the future, which is why price adjusts now. So is it just speculation? I don't think it's just speculation. For me, it's logic. If you know that you are selling something which is going to be very less available, or the expectations are those, and you see bidders coming in, what are you going to do? You're going to sell it to the higher bidder. Why not? If there are people willing to buy this one, instead of 10, they're bidding 15. Should I say, no, I cannot accept those bid at 15 because, price is currently at 10. And just remember, I bought it for 7, so I'm already making 3 for my profit margins. I can't accept, to make 8 just because you're bidding 15. It's unfair. I think, I don't mean to be rude, but I think people need to grow up here. This is not about justice. This is not about fairness. This is just business. All right? So am I too pragmatic? Am I too materialistic? Maybe, but maybe not. So after my digression, let's keep going. Let's check the prompt spread, which obviously went up and up and up in WTI. Again, a 2 hours chart, but even if you go on the daily time frame, this is how it moved from basically last Friday. So a week. 1, 2, 3, 4, 5. Yeah. And again, so I think the market, it ties into what I was saying before. The market is pricing in higher oil prices into the future, because the curve, if you think about the futures curve, it's going even more deeply in backwardation, right? And I guess it's the same for the Brent. Yeah, sure, why not? Let's go on the daily. Yeah. Now, almost $10, the spread on WTI. I mean, in 5 trading session, it went from 3 up to 14. I mean, maybe I need to double check it. But I think these are the expirations, right? K and M, which should be what? May, June, I guess. BZ, it's different. You got MN, which should be June, July, but I think no matter whichever the case, the spread it's blowing out, and the market is pricing in that this conflict, it's not going to resolve itself very soon. Therefore, again, if you read the news, there are countries in the world, like, I don't know, Philippines, South Africa, and others. Malaysia, I was reading, even Australia to some degree, but now even in Europe, they're starting to talk like that. They are already starting rationing fuel and energy. And the, you know, the savvy experts in the European Union, when some of the governments of the 27 members, they moaned or they warned about the possibility of energy shock. Do you know why are we paying these bureaucrats for? Do you know the type of answers they gave us? Oh, that's bad. I'm sorry for you. That's terrible. But you know what? I got the solution for you. You should stop using your car and maybe using your bicycle or going on foot. I mean, really? Well, if you cannot afford gas, just don't use a car, right? Easy peasy, bro. Trust me, bro. I know my shit, right? Let alone the fact that I maybe take an airplane 2 times a week to go back and forth from Brussels to whatever other silly country I live in. But hey, I'm telling you, bro, go on foot, right? Me? No, me. I'll keep flying. Why not? It's not my problem. It's your problem, right? But the silliness we are looking at, the madness, right? So, you know, is it so surprising why people are upset? Is it, right? So, with oil in this posture, with spreads blowing out, you would expect what? Well, yields shooting higher. Instead, you have what? Yields going lower. Now, sure. Wait a second. It is true, right? They had a spectacular move to the upside. So this is honestly might be just a pullback, obviously, right? Markets don't go in a straight line. We all know that. But nonetheless, the week where you see spreads blowing out in WTI and in the Brent futures market, you would expect yields to respond to it. Instead, they are going down. And for the entirety of the week, you know, from Monday to the close, they were going down. You know, maybe the 2 years a bit less than the 10 and the 30s, but you can see the direction of the market, at least for this week. And again, and I stressed it enough, but for this week, right? Maybe just a pullback, right? So why is that? Look, I think there are 2 things. One, we just said, that's how markets usually move, right? Over a long enough period of time. Okay. The other one could be, and I don't know if you should take it as a positive or as a negative, but the other interpretation could be, well, look, if the market is starting to price in higher for longer oil prices into the future, could it be that the bond market, it's waking up to the fact that at a point, it's not going to be inflationary. It's actually going to be demand destruction. Again, as our highly educated and savvy European governors are saying, stop using your car, right? Why not? And from there it would be, well, stop going to work from home. You know what? We got a brilliant idea. We implemented that in 2020 and it worked wonders. Why don't we implement energetic lockdowns? I mean, we got pandemics lockdown. Why don't we have energetic lockdown? Still an emergency, bro, right? So maybe we should once again give up our personal freedom and constitutional rights because of their incompetence. Who knows? Maybe. But so I think that could be one interpretation. At a point, what people say is the cure for high prices is higher prices. Up until the point you destroy enough demand, and what happens to the price of whatever asset when there is not enough demand to keep on sustaining higher prices? People pull back, consumers pull back, consumption goes down, bidders evaporates, and price needs to adjust back lower. And that is, at the very least, disinflationary. So that could be one interpretation. I'm not saying that is definitive. But, again, if you keep on seeing this behavior persisting, maybe you are a bit more evidences, right? And then again, it would come, I think, hand in hand with economic data deteriorating. So the labor market being even more sloppy, retail sales keep on going down, traveling dropping down, air traffic, so airplanes or all the rest, traveling, dying. So, I mean, you would have evidences which would go hand in hand with this move if it ever materializes. And, the opposite case, technically on the chart, still remains. If it is just, usual pullback and then it shoots higher, all right, then it's just the market doing its things, right? So two things you could keep on monitoring in it, and each type of movement would be the reflection of a particular scenario into the future with which the market is pricing in for now. So it's worth to keep paying attention, all right? So same for, it's just the opposite, but bonds, futures, treasury futures rebounded. The end of the week, they faded a bit. Now that I look at the futures, just remember it might be tied in with what the DXY is going to do, right? Because if you see dollar strength, you might see other countries which are forced to liquidate the reserves, aka the treasuries, right? So you would see these ones going down, and at that point, this one keep on going higher. It's just the mechanics of the market at that point, right? If you need more dollars to buy more oil at higher prices, while the dollar is going up against your own currencies, you are forced to sell treasuries to get the dollar, right? Not only to buy oil, but maybe to sustain your currency, because not only oil, but pretty much every commodity, it's priced in what? Dollars. And then you need dollars for what? Oh, well, to access global credit markets. You need dollars to acquire what? Treasury, especially bills, which are the bedrock of the collateralized system we live in financially. So, if you see yields keep on climbing higher, it might be in lockstep with the DXY, keep on going higher, all right? So many different moving parts. I know, and again, sometimes I struggle myself to keep up with everything which is moving, which is why I try to come up with these with, from many different angles and trying to come up with many different hypotheses and then trying to confirm which one is actually materializing or the odds of which one are actually increasing or decreasing. And look, quite honestly, since you don't know the future and you don't have all the answers, that's the best you can do as a, what am I? A bedroom trader or a DIY investor? I'm part of the plebs. I know that for a fact, but maybe with a little bit more of education compared to the rest of the plebs, but still part of the plebs, right? So yeah, that's me. Just a smidgen above the average Joe. Maybe, who knows? Let's just don't get ahead of ourselves, because the second you think you know it, the second you think you cracked it, it's the second usually where the market tells you, no, you didn't. And that's how I punish you. So, that's it. Now, let's transition into stocks instead. So usual brief break and then back with the stock market. Now, the equity market, it's basically that market where we didn't see what, based on the previous weeks, 3 weeks actually, was expected. So again, first part of the week, what we've seen, yeah, sure, weekly open, up we go. Then what you would have expected based on previous iterations was Wednesday, then we'd start to sell on Thursday, but then on Friday, actually, we went up. And, at the end of the day, we closed the week relatively close to the highs for the week, pretty much across the board. I mean, I don't see a very sharp pullback for now. So again, did we just break the routine, right? Look, I must say, for instance, one thing that I would highlight is that at the very beginning of the week, right, you got basically end of the quarter, right, and the beginning of a new quarter. So usually what you see It's what? Portfolio rebalancing. So a lot of money needs to be deployed in the stock market because of that rebalancing process, right? And that goes for hedge funds, pension funds. A lot of people, especially at the end of the month and the first day of the month, they might have to buy a lot, right? Just to rebalance those positions, right? Or it could even be just window dressing, right? What do you do when you get to the end of the quarter? You are about to settle those quarterly reports, and you want to show your clients that you're actually owning the things which performed well, and you own less of the things which perform badly. So, there might be a lot of adjustments there. And, I think it was Goldman. They were anticipating at least 60 billions, I think it was, in buying activities for these 2 days. So end of the quarter, beginning of the quarter, something like that. So rebalancing, window dressing, a lot of different things. When you add them on top of a market which was particularly bearish, right, because of the sentiment, the headlines, a lot of people buying puts or maybe getting naked shorts, I think then you start to dig into the mechanics of the market. Sharp moves up. A lot of those shorts, late shorters or people which bought puts really, really late into the dump, they had to do what? Well, being shaken out of those positions, and which fueled again the move to the upside. Now, I do also think there was a little bit of a news, but that came in the latest part of the week. Was what? Some sort of an announcement of an agreement, a draft of an agreement in between Iran and Oman to regulate the traffic into the Strait of Hormuz, which obviously, if you try to regulate that, doesn't mean that you want to close that. So in a sense, it was, well, the strait may be reopened under maybe different jurisdictions, rules, frameworks, whatever. But it looks like the market took it and ran with that in a positive way. I would be still a little bit skeptical, to be quite honest, because again, when you zoom out, did we really improve a lot? Like, for instance, the previous week, right? The market, I'm just looking at ES futures and NASDAQ, but ES futures were down, 4.3% in 2 days, right? NASDAQ were down almost 6% in 2-3 days, kind of the same, right? So is it so mind-boggling to expect some sort of a reflexive rally, especially in the back of, again, end of the quarter, news on our moves and all the rest? I think at the end of the day, it's just a natural tendency of the market, not moving in a straight line. So I wouldn't read too much into it. I think, again, structurally, we are still dealing with these, it was support before this area right here. Same for the Qs, it was support before. Are we just testing back into it and confirming it as resistance? So again, I'm not saying we necessarily need to go for new lows from here. What I'm saying is I would need a bit more evidences, all right? And, one of which could be, look, I want to see this market. I want to see sellers trying to push it lower, right? And when we come, around the previous lows, could be a bit higher, could be slightly lower. I want to see buyers stepping in and saying, no, we buying here. I'm sorry, sellers. Want to go up from here. We think everything is done. We had the correction. It's good enough for us. We are okay in buying at these levels. Actually, we think we are very advantageous levels for the rest of the year. So we want to buy in here. So I would like to see either these or, I don't truly believe in that, but, just breaking back higher and, holding now these levels once again and starting to go higher. So whichever the case might be, but that's what I would like to see to confirm that the bottom is in and all the rest, right? Because again, as I always say, I'm never going to come in here telling you this is the bottom. I know, trust me, bro, 100%. I don't know what the bottom it is. Same as I didn't know where the high was. I was just saying, look, yeah, I mean, we're struggling. And then we started to make lower lows, lower highs. You know what? Now it looks like a topping process. And then we went down. But I didn't know in here or in here. I started to notice in here. So I was late, yeah, but still enough in time to avoid the majority of the drop. So that's your job as a risk manager. All right. So I don't know if this is the bottom or not. I would need further evidences of that. As you know, we are still below the 200-day moving average, as you can see. Sure, we have a little bit of a signal on the buy side on the stochastic. The MACD looks like it's trying to cross to the upside. We see the first two green candles on the histogram, but you know, is it enough to confirm a low? For me, no. To be quite honest, if you just look at the moving averages and you look at the faster ones, contradicting a little bit, because we are still in that, you know, imagine there is a cloud, right, in between the blue and the yellow, right? Every time we approach this area in the past, recent past, we sold off. Now, sure, this time around, we are holding the blue one, and the blue one, the faster one, is actually trying to change its slope to the upside. But, you know, others, like, you know, the yellow, the green, they're all downward sloped. The delta in between them is still increasing. So could this be just a pullback in an overall market which is still going down? And just for reference, the blue one is an 8 exponential. The yellow is at 21. And the green is at 55. So which one would you think is holding more weight in here? Now, again, if you can see the blue actually starting to cross above the yellow, then at that point, you have the inverse of what you got in here, right? Or if you look in the past, see, every single time, the faster is always above the slower. They're all upward slope. We are going up, right? Yeah, it could be volatile at times, but overall, we're going up. And we are not there yet. So again, even when I look at these from this angle, I don't necessarily see a low to be put in, right? And look, I wanted to talk about, okay, but maybe later. Let's have a look at this one instead first. So when you look at the stock market, sure, the market is not down massively from the highs, but when you compare the drawdowns in the sector index, so, you know, your XLK, XLE, XLV, XLF, whatever, right? The usual sectors, I think I should have them right here. Yeah, this one, basically, right? The sectors, right? So when you look at them, the drawdown in them, it's the black line. But when you look at the components of those sectors, so the actual stocks, the constituents of the sectors, well, I mean, a lot of them are actually down a hell of a lot more than what the sector is telling you. So although the market, and especially if you look at the index overall, because you could extrapolate this logic from the sectors to the overall index, obviously, right? Although the market, it's not down massively. Like, look, for instance, let's get back to, let's just use ES futures, right? From the ultimate high in here to the ultimate lows so far, it went down 10%, right? 10%, normal average correction in every single year. If you look at the data historically, there is a 10% correction, or the odds of a 10% correction are particularly high. But, you know, what if you start to look at this and thinking, we have an average correction, something that we can see potentially every single year, in a situation where oil, right, did something like this, and the stock market is only down 10%? I mean, we are golden. This is good. I mean, you would expect the stock market to plunge like 30, maybe 25, 30%. We are just down 10%. Great, right? Who would have expected that, right? So I think there is a little bit of optimism about that. But when you start to check, right, the single stocks, the breadth, it's telling you that situation is a bit worse than what you would expect just looking at the index, all right? And, since the index is weighted by market cap, that just tells you that there are a few stocks which are holding up the index, but instead, when you start to look deeper into it, the equity market, it's not in that good shape. And there is a lot of damage which has been done, all right? So the thing becomes, so what's going to happen? Will we see, breadth improving and the index keep on climbing up in the following weeks and months? Or maybe that just means that the index is not reflecting good enough the damage which has been done, and we will need to see the index going farther down before things are settled and everything is said and done. That's up to you to decide, but I would say in terms of assessing the risk, you shouldn't be discarding this type of logic, right? And, again, a little bit, if you want to look at that, it's just other sectors and subsectors, and you can see that even, still relative to the breadth, what you can see is that in a few sectors, the damage is particularly high, like software, right? And we hinted at that in the past. 97% of software-related stocks are basically down more than 20%, which is the standard measurement of a bear market, right? When something draws back more than 20%, you are in a technical bear market. Do you believe that? Maybe you do, maybe you don't, but that's what the benchmark would say. While instead we got staples or utilities or energy, which are not that bad at the end of the day. So another testimony of the rotation that we had. And again, a market, it's not really collapsing up until the point you don't see all the sectors collapsing. Up until the point parts of the markets are up, parts are down, still it is a rotation. Then of course you see the index going up and down. It depends on what sectors are suffering, because again, market weighted index. So, that's that. And in a time like this, when the market is down 10% from the highs, it's a good time to bring back a discussion we had in the past. I think it was for Liberation Day, maybe. But so this one right here, it's an old logic, right? Which, as we've seen in the past, it's keeping hidden a lot of flaws, right? So they say buy and hold because you cannot lose the 10 best days of the market. If you're not participating in those days, you're not benefiting from market appreciation. Sure. The thing is, when you look at that statistically, the 10 best days are usually happening right, in the same time at the 10 worst days because of volatility, of course. You have the final washout and then the quick recovery. So the best 10 days are obviously following very closely the worst 10 days. And again, a lot of debate around it, but the simple reality is that it doesn't really matter if you are profiting from the best 10 days, right? What you need to do instead, even if you miss the best 10 days of the market, which would be the red line in here, which sure, to start out, it's already worse than simply buy and hold, right? But if you're just focusing on managing your risk and missing the 10 worst days, look at your performances over time. Now, sure, it's easy to see things like this, right? In the sense that nobody knows if you would actually hold, sell, if you were positioned well. But, conceptually, this is another testimony that what counts more, it's risk management. If you take care of the downside, the upside will take care of itself. So, just for the sake of it. If you then look at the market on a weekly time frame, oh, I'm kind of dying in here. On a weekly time frame, what you see is that the market is down now. What 1, 2, 3, 4, 5, and the Q 1, 2, 3, 4, 5. So 5 weeks of a consecutive bearish closes. So when you go back in time and you look at how consecutive weekly losses you could have, we got up to 5, which, starts to be in the upper boundaries of the data set, getting back to the 60s, as you can see. So, these rally that we got now this week where we bounced, it's just, fitting the statistical data set overall. Does it mean, right, that this is the ultimate bottom? Maybe, maybe not, right? Like, even for Liberation Day, if you zoom, just last year, 1, 2, 3, 4, down it goes, and then, you have a green one. So it fits the statistical model, right? Yeah, good enough. But then after that, you have another 2 candles. And you might say, oh, there are just 2 candles. Yeah, sure, but it's another 11% down. So to some degree, it tells you that at a point, every single move will need to have a bounce or a pullback. But that doesn't mean that the direction of the market is completely changed right here, right now, just because we had this rally. So again, would you trust this rally? I don't know. I don't personally. What you do is up to you, right? Then we got these. Now we got the seasonality statistics for it, the month of April, all right, which on its own, right, it's not bad, all right? It's actually one of the strongest months of the year. Right? Look at April, and then what you got better. October, not really. November, yeah, November it's better, and then December it's good enough. But April, it's kind of cool, right? Although, again, in the grand scheme of things, we are in what? In the second year, and in Q2 of the second year of the presidential cycle. And again, we touched on this subject, right? So, on one degree, April would be a good month. On the other hand, it's happening in a period where historically we didn't have such huge returns. So which one would you trust more, right? If you look at this one, it looks like we are in the worst quarter of the 4-year cycle, again, the presidential election cycle. So again, if you add on top of it what's going on geopolitically, I would say still this is not the time to get over optimistic or euphoric or trying to buy every single dip. But I would assess this current time as still the time to be nimble and more defensive rather than aggressive, right? Now, this is interesting. This is where I was kind of, waiting a little bit because I wanted to show this, which is basically you got the VIX on the upper quadrant and the SPX in the lower one. Now, I highlighted these 25 level because what you see is that basically when we got periods where we just spike into it, there is a buy the dip opportunity more often than not, like in here, or, if you go in the past, could have been in here, right? Kind of. I mean, the market rebounded a little bit, while instead, when the volatility index actually stays above that level substantially, that's usually not a good buy. And when, it gets back below it, like in here, then, you have the green light for buying and keep on buying the dips, right? So, many different instances, even in here, right? The market drops and then you buy the dip, it pulls back. Sure, this time was in the midst of a topping process overall, but nonetheless, if you buy this one, you have 1, 2, 3 days of upside only. So the distinction here is in between the VIX being stable around this level or, just quickly spiking into it. So another way by which you could assess risk, it's now, if we see the market keeps on climbing higher, reclaiming the 200 days moving average, right? And potentially these blue moving averages crossing above the yellow, so crossover, bullish crossover, while we got volatility coming down, at that point you have further confirmations that this was maybe a good low to be bought, or at least from here on out, you could start to get into the old mentality of buy the dip, right? But the situation here, which is described, it's basically it is a delta, I think. This is a subtraction because this is the VIX minus the realized volatility. Now, the VIX, as you know, it's measuring the implied volatility, right? It's basically measure the premium that people are willing to pay in order to buy puts. So in order to hedge themselves buying puts, the more demand there is for puts, the more, the higher the premium you are willing to pay for them will be. So the VIX is, in very basic words, it's kind of a reflection of that, so, which is why it's called the fear index. Because when would you buy puts to hedge your portfolio? When you fear that we are going to see a downturn, right? Market going down. All right. And then you have, the implied volatility, which is the VIX. So how much people would think the market could go down. So the possibility of a downturn, right? And then you have the actual realized volatility. So how volatile the market actually was in that time span. If you make this subtraction and you measure the difference in sigmas, which is basically another way of calling standard deviations, what you see is that now the VIX, so the implied volatility, is actually 2 sigmas, so 2 standard deviation higher than the realized volatility. Now, there are 2 ways by which you can interpret that. And one, of course, is a bullish scenario. The other, it's a bearish one. Now, if you go with the bearish scenario, that would imply that at the end of the day, the VIX is right. And the market, the option market, is actually pricing in a risk that the equity market is not really seeing yet. So the implied volatility is higher, and the only way this chart will get back towards zero line, it's by realized volatility increasing and catching up with the implied volatility. So we need to have more volatility realized into the markets, which usually comes when you have the markets going down, right? Historically, volatility increases when the markets are going down. So that would be the bearish scenario, the bearish interpretation of this, right? But instead, if you want to look at things with through rosy glasses and all the rest, right, the glass half full, what you might say is, well, look, I think instead the VIX, the implied volatility, is wrong and the realized volatility is right. Because at the end of the day, maybe the fact that you don't have such a high level degree of realized volatility, it's because at the end of the day, the market, it's not that concerned. They are looking through everything which is going on, like the war, the oil spike, and all the rest. They are thinking that it is going to be temporary. And when it's all said and done, when it's all resolved, right, we are not really having a lot of deterioration as for what? Earnings projections, right? Earnings into the future. So maybe realized volatility is right. And VIX, for now, it's just, indicating sentiment, panic, or, whatever, fear. And what would you say usually? What you need to buy when? Well, you need to buy things that no one actually wants to buy. And you need to sell things that everyone is willing to buy. It's kind of the contrarian type of argument. So I think both cases are actually valid. And so again, it's another thing that I want to throw in there, just because if you keep on monitoring this one, you might have an insight in what market participants are actually thinking. Now, to be fair, disclaimer, I took the screenshot, I think it was probably Tuesday, maybe Wednesday. So, if you look at the VIX now, it's already a bit lower than where it was when I took the screenshot. So it might be that even this ratio right now, it's not anymore at 2 sigma. It could be a bit lower, right? Considering that the VIX, it's coming down. And again, even by simply monitoring the chart, right? Although the screenshot is a bit old, maybe 2 or 3 days old. But again, if you see the VIX coming down, it means that the bullish scenario is actually materializing. Implied volatility comes down, therefore realized volatility was right, the market will bounce, and we are all, cool and dandy at the end of the day, right? So another thing you could try to implement in your strategy if you're running a portfolio, right? Then what we got is, well, these, you want to throw in that? You know what? Maybe, yeah. This one right here, so basically is another measurement of market breadth, but it's combined with money flows, right? Just read the description for yourself, right? I'm just going to comment the chart below, okay? But again, it's another way of assessing if there is buying or selling pressure in markets, right? And the calculation is explaining here. You read it, pause the video, do what you like. I'm just going to be focused on the chart. So we see that we are in between 40 and 30% on this indicator, right? Which it indicates selling pressure. Okay, that's cool. Now, obviously, if you just check the dates and you go back to a stock market index chart, you would see that more often than not, when we reached into the 30% level, we were at, if not very near, a bottom in the market. But what is curious for me is the stats that you can come out up with. So look, these are all the stats. Again, you can read them, but I would be a bit more focused on the takeaway in here. So where we are right now, 35 to 40% current zone, which is, again, I'm going to highlight it again, in here, right? 40, 30, we are in the middle, 35, basically. So when we are there, right, current zone, in 1 month, so after 4 weeks, the returns were minus 1.1. After 3 months, minus 1.2. After 6 months, minus a little bit. And then after 9 months, they were positive. So it looks like we are not yet at a point which could signify a decent enough bottom to buy with confidence and, you know, to hold for the long term, because, you know, that's a very good bottom. Instead, if we could have just another washout in this market, so another wave of selling coming in, bringing the read below 35%, the data, the returns for the future, they actually changed dramatically. And as you can see, right, if it starts to go below 35 or 30, you have 100% win rate after 12 months, right, to gain an average return of, call it 16, 15%. And, you know, and these are the data, right? So in between 30 and 35, after 4 months, 2.6, after 3 months, 1.3. But when you go farther, you know, away into the future, after 6, 9, 12 months, markets, it's decently higher, right? So it's just another thing that you could look at in order to assess if this is a low that you want to buy or maybe not, right? So again, this is why I was saying, all things considered, I wouldn't mind having these low confirmed by another wave of selling, getting back near the lows. If we have another one and the lows actually hold, yeah, all right. And then, of course, after that, you need to do all the things we were talking about, right? Momentum, shifting back higher, reclaiming this sort of old support, which is now broken, moving averages crossing over. At that point, I would say, look, this is a decent bottom now. I want to get back in. I want to get back into buy the dip mentality. Did I miss? By doing so, would I miss the actual low? Yeah. But again, you're just sacrificing opportunity for more price information, aka confirmation. So you're sacrificing your potential risk reward for what? More odds? So I guess, again, it depends on you. Maybe you want to try to catch the knife. You would absolutely increase your risk reward, but your odds, your probabilities might be decently lower, while instead you could wait a little bit, having a bit more odds in your favor. Sure, your returns would be lower as well. There is always a trade-off there, so pick your poison, all right? And lastly, I think, I know it's going to become really, really long, but I think that the odds of a recession increasing or decreasing or actually materializing itself, it's going to be another important factor in how the market will shape up itself in the next weeks or months. So let's have a look at these, for instance, which is, again, I think it's good to put all the pieces of the puzzle together because everything is related at the end of the day. These are previous recessions, right, which came in after oil spikes, energy shocks, right? Pretty self-explanatory in here, right? And again, you can see the results back to the 70s, the percentage oil spiked. Did we have a recession? Yes, not, maybe, all right? And what type of impact the S&P faced, all right? So just to give you the sense of why you might want to check this out. The spike, the result, and the effect on the stock market. This is why it's tied in, right? These are the factors, right? So again, I'm not saying, right, that it's going to be definitive. Every single one of them will line up, but these are a few things that you could look at in order to assess the odds of, in this case, the US economy slipping into a recession or not. And of course, the duration of the shock, the inflation conditions before the shock, right? What the Fed will do. And in my view, it depends a lot on the fact they are smart or not. Like, very quickly, look, if you think the inflationary pressures are driven by supply constraints, you do nothing. Because again, nothing you do will, force more oil out of the Gulf or out of the ground, right? If you instead, if you see that GDP is actually going down, right? So this inflation is causing damage to the economy. Well, at that point, you should cut, in my view, in order to rescue the economy. Because again, there is no risk of inflation. If the economy is going down, how can you have inflation if GDP is going down? Consumption is going down, the economy is falling into a recession, jobs have been lost. Who's going to be there bidding all the precious items up and up? If everyone is losing their job, having to sell their house, right? Not being able to access credit. So I think that's what the Fed should look at. This one interesting, energy intensity of the economy, right? And show the position of the US, so which changed a lot over the last decades, right? From an energy net importer, highly dependent, to now being a huge exporter and producer. As for the intensity, energy intensity of the economy, this is a good chart you can look at. So this is basically a representation of, how much oil is required to produce 1 unit of GDP. And as you can see, what basically tells you that the American economy became more and more efficient, right? So it's another thing to consider when you have to assess the impact of an energy shock on a particular economy. In this case, we're talking the US, right? And yeah, I mean, the energy net position, I think there is nothing to discuss there. It's evident, right? But what you have is this. So mixed bag results again, because on one side, energy intensity, yeah, it fell. US net exporter, sure. Now you have the strategic reserve architecture, which you didn't have in the 70s. And again, the objection might be, sure, but they were already depleted enough after the Biden administration, before this Iran conflict. How long can they actually tame the price of oil? Maybe not for so long, but still better to have them than not, right? Inflation expectations, which are a bit elevated now, but still they're not unanchored like they were in the 70s. So are we in the 70s again? Maybe, but maybe not. I mean, just read the paragraphs. There are good arguments for both. I personally think we are not, right? And I look at that not only from these perspectives, but I look at them from the perspective of the monetary system, which is, different now. It's behaving differently. It's in a different stage. You could add the credit cycle on top of it. So I don't think we are set up for a credit expansion. Sure, you might say, well, but we got MMT, bro, now. So, you know, money printing, QE infinity, it's going to come out good. We're going to have inflation and all that. Sure, maybe. I still don't think so, but I would accept that type of argumentation and you know, in contrast, to be fair. That would be legit, right? So, to sum up, this is a representation of the factors which could mitigate this energy impact on the economy and therefore on the markets, and the ones which are actually pointing more to a recession. It looks like at the end of the day, the recession camp are winning for now. Recessionary boys, for now, looks like they have more odds. We'll see. We will see if they materialized or not. And again, as you can see, another representation is to answer the question, did every single oil shock resulted into a recession? It looks like the majority of them actually did. So will it be different this time? These are a bunch of stats, numbers, logics, mechanisms, dynamics. You come up with your own interpretation and your own assessment. I just thought to present the data and let you decide for yourself. Again, as I said, I think the odds for a recession are increasing. And they were increasing before for me because of the labor market deterioration and all the rest. But could this be the final straw which breaks the camel back? Maybe. We'll see. Whichever the case, I think even if you have a recession, I think it's going to be nowhere near severe of the, you know, compared to the type of recessions you could see in some other countries, like in Asia or in Europe, for instance. So again, we get back to the same old topic of when you are the king in the mountain, would you really care if the mountain is high or low? No, up until the point you're on top, you know, it's a relative strength game. So who knows? We'll see. After that, the video was particularly long. I do realize that. Too bad. A lot of people won't even watch it because they're out. But yeah, I mean, that's where I will leave it. And after that, I'm going to wish you a good Easter. It's going to be Easter on Sunday. So have a good time. Spend it with your friends and family. And the market will be open back again on Monday for the US, really Tuesday for Europe. So I'm probably going to be back on Tuesday, most definitely. But whichever the case, in the meantime, be nice and be cool. Neil's out.
What have I told you since the first day you stepped into my office? There are 3 ways to make a living in this business. Be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.